Welcome to the daily insights that matter. Now, in an era characterized by global connectivity and an increasingly borderless world, financial movements have taken on a remarkable momentum. Now, with that, India's outward remittances under the liberalized remittance scheme have surged by 50% in the first quarter of FY24. Now, this surge can be attributed to a robust expansion in various sectors as a result of changes in the schedule for collecting taxes at source under the LRS scheme, along with the return to more regular international travel patterns. Now, under the liberalized remittance scheme or LRS, a resident individual can make foreign remittances up to $250,000 per financial year for permissible transactions like education, medical treatment, employment, immigration, travel, investment, etc. Now, in the first quarter of FY24, outward remittances under the LRS scheme surged 50.64% to $9.1 billion compared to the $6.05 billion registered in the same quarter last year. Now, when we look at the breakup on a year-on-year basis, the primary factors behind this were substantial increases in equity and debt investments, as well as property acquisitions, all of which experienced growth in the triple digits. Now, other components on the list included deposits, international travel, and medical expenses. Now, the lone unfavorable aspect was related to expenditures for education abroad. Now, the surge in remittances can be attributed to Indians taking advantage of the postponement of the tax collected at source on the LRS regulations to 1st October. Now, during the Union budget for FY23, the government had proposed raising the TCS on liberalized foreign remittances to 20% from the existing 5% limit on amounts exceeding 7 lakh rupees for all purposes except education and medical treatment. Now, this would impact individuals making remittances abroad from the effective date of 1st October, and many of them are utilizing and taking advantage of the current regulations. Now, though the impact of a TCS at 20% will substantially affect the economy, its actual consequence can be computed once it comes into effect only. Now, India's banking system liquidity has slipped into a deficit for the first time in this financial year on the back of Reserve Bank of India's temporary liquidity withdrawals and tax outflows. Now, the banking sector surplus has hit a high of 2.8 lakh crores at the start of this month, but since then it has been dropping, especially after the RBI asked banks to hold on to an incremental cash reserve ratio of 10% on the rise in the deposits between May 19th and July 28th in this year. Now, this has led to withdrawals of over 1.42 lakh crore rupees. Now, liquidity also narrowed due to heavy GST outflows and auctions as well. Now, according to a Kotak Mahindra Bank report, for the week of August 19 to August 25, outflows worth 1.5 lakh crores of GST are expected now, and outflows worth 63,430 crores are expected on account of auctions of state loans, T-bills and government securities. Now, on the other hand, inflows worth 1.23 lakh crores were expected on the account of coupon inflows, redemption of T-bills and state loans and the government spending as well. Now, the banking system liquidity therefore stood at a deficit of 23,600 crore rupees as on 21st August 2023. Now, in the last few months, liquidity in the banking system had risen sharply after the withdrawal of the 2,000 rupee notes, the transfer of RBI surplus to the government, an uptick in government spending and capital inflows. Now, the central bank has announced the incremental cash reserve ratio to absorb the surplus liquidity generated by these factors. Going forward, the foreign exchange interventions carried out to manage the Indian rupee's depreciation could further weigh in on the liquidity. However, RBI Governor Shri Shaktikant Das Ji has also assured that the incremental CRR requirement will undergo a review on September 8th or even earlier, depending on how the situation evolves. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com.